Hi guys, this is Tim Melvin of the Tim Melvin Deep Value Report and Banking on Profits newsletter, coming to you from down here once again on an early evening in Central Florida. I was sitting around last night, watching my usual Sunday night TV, and of course missing the zombies, but they'll be back, I guess, in February. But checking my Twitter account, there was a retweet of a fellow. Trading with the Fly is his Twitter handle, and he has a blog over at ibankcoin.com. Very aggressively named accounts, both of them. But I have followed the guy for a while. If you have language problems, don't follow this guy because he's not afraid to use some. But he observed that. And I've followed him for a while, as I said. He's had some pretty good market observations along the way, and he's kind of an interesting guy. Um, but he observed that for stocks under $1 billion in market cap that traded more than 500,000 shares a day, the median was down 49% on the year. Now, that seemed really aggressive to me. I know there's been a little bit of a rolling bear market underneath the indexes, but and microcap as a whole is down on the year, especially microcap value, as we talked about. It's been a tough year to be a value investor, but I checked it today, and he's right. The median stock uh, under $1 billion in market cap that trades, 500,000 shares or more a day, is actually the median stock's down almost 50% on the year. It's crazy that you've got this stealth bear market going on. There's so much money now going into investing in and just trading in the indexes and large sector ETFs that the stuff that's not in the indexes is just being left behind. It's painful to endure, but it is, as this keeps up, it's going to create some serious opportunities for deep value investors. We'll see exactly how it plays out. We're going through the list of those stocks now, looking for potential bargains. Most of the ones we found that we like, we already own, but we'll keep digging at it. But we really have an incredible stealth bear market going on. Smaller stocks are not participating, what I hesitate to call what we've had this year a rally, but they're not holding up as well as the broader market. And we saw last week that several mentions, I saw it on Jacob Walensky's excellent valuewalk.com, that if you take the top 10 stocks out of the market, all of the performance goes away. Those stocks have all been up as a group, the top 10, I think it's like 50%, and the FANGs have been just spectacular with gains. So that's Facebook, Apple, Netflix, and Google, all up over 60% on the year. So all the money is coming into just a very narrow funnel and favoring just a very small handful of stocks. Has a very 1970s Nifty 50 feel about it. And if you may recall from the history books, didn't end well. Not quite sure it's going to this time either. That's a lot of money going into just a very few stocks that all traded, with the exception of Apple, which is kind of reasonably priced actually, traded very high multiples of earnings, book value, sales, anything you want to value it on. So we do have just a definite hidden bear market. I don't know when the indexes will roll over. I have no idea. Um, Bull market's getting very old. That does not mean it has to go down right away. Nothing's going to go short term as I need it to. Anyway, I've learned that over the years. So we just got to sit back, wait how it all plays out. But it definitely does appear that small caps have been decimated this year, and there may well be some bargains amidst the rubble. We'll be looking into that deeper. Um, all Fed all the time right now, right? Tomorrow we should get the first Fed interest rate increase in a long time. They'll take it up a whopping 25 basis points. We rallied today. My best guess is if they announce 25 basis points and they have measured language, careful language about a measured, slow, data-dependent approach, it'll have a very benign impact on stocks. This is pretty widely anticipated. Where we run into any trouble tomorrow is if the Fed comes out and says they're not going to take the 25 basis point increase, because the only way you can take that is things are much worse than we expected, and the economy is not strong enough to justify even this very small interest rate increase. Best bet, they raise 25 basis points and not a lot happens, maybe even a continuation of today's rally. But I'm not a trader. We'll just kind of sit back, see what happens and how all this plays out. In theory, 25 basis points should not matter much to the market or to the economy, but there's a long road between the theory and the actuality. So we'll see what happens starting tomorrow. Did a little repositioning this week. I sold some stocks, and the ones that I've owned them in the newsletter pretty much from day one, so about 2.5 years now. And these were all situations where the hurdles facing the particular sector or the company were just tremendous to overcome. And even if I looked out another 2.5, 3 years, just didn't see it getting a lot better, or the financial condition had worsened, not improved over the past couple of years, or I just felt management was not, frankly, up to the task. So, and understand this was not a whopping number of companies. It was 7 stocks, I think, that I sold. And I bought a couple of REITs that I think are extraordinarily attractive with huge, frankly, long-term appreciation potential. But I forgot the golden rule that Tim's not allowed to sell stocks. So I got my usually flow of why are you selling stocks? I thought you had a private equity mindset and didn't sell. I do have a private equity mindset. We do still have a lot of stocks that we've owned since day one of the newsletter. But if things are worsening, not improving, at some point you admit you were wrong and move on. Having said that, I love the way we look in the deep value portfolio going into 2016. Of course, oil going up makes a huge year for us, even if we don't invest any more of our sizable cash position. But so we've got the oil and energy stocks. We've got some banks. We've got some REITs that are trading at drastically undervalued levels, in my opinion. We've got a few banks. We've got some net stocks. I like the way we position. I think we may finally break our value slump, as we've talked about. It's been a tough couple of years for deep value investors once you moved outside of the community bank space. 2014 was not a great year, and 2015 has just been horrible. I look at the names, and I've got them down here. Some of the guys that have just gotten smashed. Mason Hawkins, one of the most dependable conservative value types out there, has had a terrible year, mostly because of energy-related names. The guys at Aegis Financial, who have a great track record buying stocks below book value, have really struggled this year. Carl Icahn, in his major energy positions, has taken a beating. Check out the price of AEP, his publicly traded fund, and see what that has done. And of course, David Einhorn has just nothing's worked for Mr. Einhorn this year. I'm sure he's not broke. The guy's worth a couple $1 billion, but it's just tough to take those phone calls when everything you've done has pretty much gone against you in a year. Just a tough time for him. I don't think he's gotten stupid. I just don't think this is a great environment to be a value investor, and he's a large one. Practices pretty hardcore value approach, and he's paid for it. And of course, the big one, this Third Avenue funds, years of a stellar reputation, flushed down the toilet by some really unfortunate decisions in the distressed bond market. And Third Avenue Credit Fund, they probably should have just sucked it up and held a lot of cash, because there have not been tremendous opportunities in the distressed market. We've watched Howard Marks of Oaktree just kind of sit on the sidelines raising cash for when the distress does become attractive. Has not been very attractive, not a lot of well-priced stuff there. Third Avenue was in some really dubious liquid paper, and the fund has taken a shot, and I think it's hurt the whole fund complex's reputation. And of course, the regular funds are value funds, so they've kind of struggled through the year as well. So a lot of guys have taken a hit, me included. My renewal rate on the deep value product is we're not even talking about it. As I said, if oil was to go up in the first quarter, we're going to have the best performance with the fewest subscribers in the history of the newsletter business. I'm confident we're close to a turnaround. I've been through it before. I don't lose a lot of sleep over it. And of course, the fact that we've had huge cash balances, and if you're following along entirely, you've owned a lot of community banks, we're walking out of the year with solid returns that are multiples of what the market has had to offer in 2015. Having said that, we've learned a lot of lessons this year. Some of them the market took a stick and beat them into us. Some of them because we've really stepped up the research and testing around here this year. We've spent a lot more time. It's gotten a little more technology friendly for me, so it's not the hunt and peck and dig through the paper guides and try to work it through Lotus 1, 2, 3 that I've done over all the years. And watching me work with Excel could make you cry. Actually, I'm not very good with it, so I have to struggle. It takes me days to do what other fellows can do in hours. But we did learn a few lessons. One of the biggest ones in long conversations with Tobias Carlisle, Wesley Gray, and some other folks, as well as reading a lot of research, we find that the value world kind of breaks up a little bit. I've always used price to book value. What I've found, however, is that enterprise value to earnings before interest and taxes is at least as important as book value when it comes to non-financial stocks. Now, book value is still important in some special situation type stuff. And of course, net current asset value stocks, that's always based off of asset value. But when you're evaluating regular operating businesses outside the financial and REIT space, that enterprise multiple makes a lot of sense to use. In financials and REITs, it's still price to book value. The enterprise value doesn't quite work in those situations because the capital structures are so different from a normal factory company or staffing company. We happen to have a lot of staffing companies right now, so I'll talk about that. So the enterprise values matter, and outside the financial world, inside the financial world is price to book value. That makes perfect sense, and here's why. When a strategic or private equity leverage buyout investor is looking at a non-financial company, they're using enterprise values. When a buyer is looking at a financial company or REIT, they're looking at asset values. So it makes sense to me to step back, change the way we look at the world just a little bit, and look at these companies the way a buyer would look at them. Non-financial, enterprise values; financial and REITs, asset values. Makes a lot of sense. Tests out just about perfectly, not only in my research, but Tobias and Wesley are much better researchers and much quantitative guys than I am, and they've found pretty much the same thing. So we're going to adjust our arsenal a little bit to include those enterprise values just a little bit more going forward. One of the big ones for me is Gary Antonetti's book, had Dual Momentum, was interesting, and he trades ETFs with his system. So I came back, and it trades a lot if you use it on individual stocks, the way it's designed. However, if you come back, you take the Dual Momentum model, stock has to be positive performance on the year and outperforming the market. Okay, then what we find is we use that with a 1-year holding period and stocks trading under book value. More on that in a second. You blow the market away, and you blow it away by beating it in up markets by a good percentage, but nothing to write home about. But then in bad markets, you kill it. You're only owning stuff that's going up. In truly bad markets like 2000 and then 2008, you don't own any stocks. It's just not there. You're 90% or more in cash throughout the worst parts of the bear market because stocks may be outperforming the market relative strength, but in relative momentum, in absolute momentum, there's very few with positive returns in a very bad market. You don't actually get back in until things start to improve and you come off the bear market bottom a little bit. It's fascinating. We have some more work to do with that. We're not going to totally modify our portfolios with dual momentum strategies just yet because we have a few more tweaks and twitches we want to make, but it's going in the arsenal. I can tell you that right now. The performance is outstanding, and it just plays such excellent defense and keeps you out of the really bad periods of stock market performance. And if we look at that, we ran the portfolio for 2014. It's beaten the market. It's around about double the market's rate of return is what we found. And as you came into 2015, you didn't own any oil stocks. You didn't own any material stocks. All the stuff that's done so badly this year and hurt the value of portfolios, you don't own them. What you did own was a lot of little insurance companies, little REITs, and small community banks. So it's had a pretty good year. You've managed to avoid the major missteps of the stock market. Trailed off a little bit because you do own some small operating companies that are part of that stealth bear market and just have not picked up any buying pressure during the course of the year. But overall, you avoided all the most dangerous spots in the stock market using the double momentum approach to individual stocks with a 1-year holding period. It's fascinating information, and we're going to be weaving it in to the way we practice value investing as we go forward once I'm done with the tweaks and twitches that I want to make to that approach. Okay, now, we're working hard to quantify this one, and I'm probably going to have to call for outside help because, I'm not a great computer guy. I can hold my own, but on massive projects, I'll bring in somebody that's a little better than this stuff. But lots of strong anecdotal evidence that the Mr. Womack and Hetty Green approach to the stock market makes an incredible amount of sense. Deep value, especially deep value, tends to outperform after a bear market ends by a significant percentage. And I'm talking huge numbers for the first let's call it 3 years after a bear market ends, but then it kind of starts to revert to the mean, comes back to the market level, and eventually falls behind it. Those are those periods where we talk about value investing lagging the stock market, and it can be difficult to put up with when you're underperforming for a few years in a row, as we have the past 2 years. I mean, if they gave awards for bad timing, I would absolutely get it. When we went back and look at the returns from 2009 up through the end of 2012, they're huge numbers. And those of you that have been reading my stuff on real money over that period of time will recognize the truth of that statement. We had stocks that were just going up, by significant percentages that we bought in as things came to a bottom in 2009, and how long we had just a really strong run. Things started to level out. Boy Genius here starts a value newsletter in 2013, just as deep value begins to revert back to the mean. So there is a lot of evidence that about 3 years after a bear market ends, you've ran up some really big gains. It might be time to step back, like Mr. Womack would go to cash, but we can come back and look at special situations, closed-end funds trading at a discount to net asset value, community banks, certain special situation stocks, and focus more on those than the traditional Ben Graham deep value approach with a heavy cash balance in addition. So there's definitely that reversion to the mean and then underperformance trend in deep value approaches, pretty much all of them. By the way, even when you had the momentum, remember you were in cash for extended periods of time. When markets finally died of old age and ran over, you might have been better off just stepping aside entirely during those periods of time. We got a lot more research to do on that, but it does indeed look like Mr. Womack, Charlie Munger, who talks about not getting rich, from mediocre opportunities, and it takes a lot of character to sit around with all that cash waiting for one to come by. We've been doing that for a couple of years now. I don't know when we'll get it. I'm pretty sure that we will. And we wanted to say we got a little bit more research on that, but this is a solid idea that as bull markets age, you want to start shifting away from deep value and in more focus on quality and special situations and lots of cash. We'll be back to you with the results on that when we're finally done with it. Now let's see what else we have. Okay, so we're going into 2016. Here's what we're looking at. It looks like a lot like you should have been positioned coming into 2015. We have lots of cash. We favor community banks greatly. We like selected energy. We have no idea how this stuff will do in 2016. We're looking all the way out to 2020 and saying, pretty sure we're going to make a lot of money by then. May be rough, especially in the first half of 2016 with our energy positions. We have some small REITs that trade for well below net asset value that we have a great degree of confidence in over the next couple of years, and of course we'll just collect those dividends. We have our closed-end funds that are trading at a discount. At least one of them has already agreed to an open-end proposal. We're going to make a little bit of money on that in the first quarter of 2016. But cash levels remain high in the value and international deep value portfolios. We refocused the income letter. I decided to hold just my favorite business development companies and REITs and get more operating businesses into the portfolio. That was the original plan, but as time went on, we got a little overweight in the business development companies and the mortgage REITs in particular. So I trailed back, pulled back some of that exposure, added dividend paying and dividend growth operating companies to the portfolio. And I think we had an okay year in that portfolio. I think we're going to have a great year in 2016 because I absolutely love the way that portfolio is positioned. It's pretty much close to fully invested. That was sort of the idea all along for that portfolio. I think we're only got 10% in cash in that one. So we've got everything repositioned. We're pretty excited about it. We think it's going to be a strong year. Ideal scenario for us is we hit an oil spike that causes a stock market collapse. I'd love to see it, but I'm not going to predict it or count on it. We'll just continue to work away finding safe and cheap stocks that can give us solid long-term performance. And when we're wrong, we'll admit our mistakes and step out of the way. So anyway, what do we got here? We're going into the sports dead zone, guys. Normally this, NFL would be fun. We'd be getting excited. I could care less. The few games I've watched this year have been horrible. Parity and salary caps have made the NFL almost unwatchable. It's become a highlights-only kind of thing, much like the National Basketball Association has become. I might have football on in the background, and I do still enjoy, college games. Army, Navy, go Navy, 14 years in a row. But the pro game has become almost unwatchable for me, with the exception of the highlights. Thank you, Sports Center. It saves me all Sunday now to go do something else for the rest of the NFL season. Looking at the hot stove, Cubs and the Giants have gotten real serious. If I'm in the National League, I'm a little bit concerned about those two teams because they both got a lot better in the offseason. The Orioles, we've done okay. We got Darren Day back as a closer. We re-signed Matt Wieters. We don't have Chris Davis yet. That could be an issue. Still got the same strong core, but we're desperately in need of a big bat and a top of the rotation pitcher. We'll see if we come up with one before pitchers and catchers report on, I believe, February 18th this year. So that's about all we've got from down here. We're getting ready for the holidays. Pretty excited about it. Wife's got the house all decorated up. I don't like it when people start this holiday stuff early, but as we get closer, I really do enjoy the holidays. The Christmas flamingos are all lit up out in the front yard and kind of guarding the house. She's got everything lit up out there, and the whole neighborhood, basically, our whole street is nothing but Christmas lights right now, so it's pretty cool. So looking forward to a great holiday season, a strong 2016. We're learning lots of stuff. We're going to keep learning lots of stuff and applying it to portfolio to make performance better. And of course, we've got our bailout. Community bank merger and acquisition activity is actually going to go up this year. 80% of banks, more than 80% of banks, over $5 billion of assets have said, according to the Bank Director's M&A survey, they want to buy another bank next year. Almost 70% of the banks between 1 and 5 billion said in the survey they want to buy a bank next year. Pretty much the majority, over 70% of CEOs below $1 billion in assets have said we are aware that we need to grow very fast and we have to get to the 1 billion or greater mark to be competitive in the current environment. It's going to be a lot of takeovers next year, folks. We've had 8 this year. That was after, I think, 10 last year in total. I've had a couple recently. Banks that were taken over that I bought 3 years ago before we started banking on profits. So that's been kind of our escape hatch. If you don't already have banking on profits, you absolutely should sign up for it. If you're new to the idea, start off with banking on profits monthly, and then as you become more comfortable with it, you can move up to the regular banking on profits service. And of course, right now, if you sign up for Deep Value for 30% off, we'll give you banking on profits monthly free for a year. So I don't, rush to your machine, guys. Click on. Let's get this done. Let's get into 2016, have some fun, and make some money. All right, that's about it. Wife's got dinner going. I can smell it cooking, so I got to go eat. And I will talk to you guys next week.